Bitcoin is the best performing asset of the last 10 years.
The absolute best.
The best!
And if you're watching this, you probably knew that already. But how well do you know why that is? What makes BTC so valuable, and why are institutions and governments taking it so seriously nowadays? After all, not that long ago, it was just silly internet money. If you still think the answer is pure speculation, then this video is for you. We've got a new report from BlackRock that lays bare the real reason why elites are accumulating BTC as fast as they can. So, if you want to find out why, you'd better lock in. So, the report we have today comes from BlackRock, and it's entitled Bitcoin, a Unique Diversifier. Now, BlackRock's thesis is contained in the subtitle, Why Bitcoin's Appeal to Investors Lies in Its Detachment from Traditional Risk and Return Drivers. We'll get to that in a moment. But first, BlackRock. Now, we all know that since the spot ETFs launched back in January, BlackRock has been Bitcoin's biggest cheerleader on Wall Street. But you may be surprised to learn that it's actually been dabbling in crypto for more than 2 years now. In the foreword to this report, the authors remind us that BlackRock began offering its institutional clients the ability to invest and trade in BTC back in August 2022. This was when it integrated Coinbase Prime into its portfolio management platform. And in the same month, BlackRock also launched a private BTC trust for its institutional clients. This is just something to keep in mind when we discuss the spot ETFs, because they tend to be talked about as a watershed moment in institutional adoption of Bitcoin. And this is partly true, but if you saw our last video about who is buying the ETFs, you'll know that the inflows are mostly from retail investors. Institutions who wanted BTC have been able to get their hands on it through BlackRock for quite some time now. Anyway, the authors also tell us that BlackRock spent years studying Bitcoin before any of this came to fruition, and from the report, it's clear that they've done their homework. This report covers 3 or 4 main themes, namely, why Bitcoin matters, its unique risk profile, its low correlation to other assets, and why all of the above make it an excellent portfolio diversifier for TradFi investors. So, let's start with why Bitcoin matters. Now, if you're subscribed to this channel, you probably don't need persuading. But for what it's worth, BlackRock sure knows how to market this thing. The report describes the basic properties of BTC as, quote, breakthroughs to multiple centuries-old problems that other forms of money have struggled with. Specifically, these problems are inflation and debasement, difficulty transacting across borders, access limited by geography, and control by a central authority. Bitcoin resolves these problems by being a decentralized, permissionless, and truly open-access monetary system. Nothing like this has ever existed before. BTC's hard-coded supply cap of 21 million units means it can't be easily debased, and its digitally native nature means it can be transported anywhere in the world in near real time at near zero cost. For the first time ever, we have a form of money that makes moving value across political borders completely frictionless. Now, the authors include a slightly unsettling footnote, though, which reads, quote, there is no guarantee that the current 21 million supply cap for outstanding Bitcoin, which is estimated to be reached by approximately the year 2140, will never be changed. It's safe to say that this is just BlackRock's lawyers playing it extremely safe, but sheesh, it's enough to give you goosebumps. Well, good to see BlackRock won't be getting sued if an attack on the network ever succeeds, or if they cause a fork via their influence on publicly traded Bitcoin miners. Anyway, moving on. The report turns to BTC's historical performance. This covers the 169 months between the launch of the first Bitcoin exchange, Mt. Gox, RIP, in July 2010 and the end of July 2024. So, who knows how many X's BTC gave us during this period? Drumroll, please. 807,000 X. Whew, not too shabby. Now, the report points out that BTC has outperformed all major asset classes in 7 of the last 10 years, leading to a return of more than 100% annualized over this period. The other 3 years, Bitcoin was famously the worst performing asset, with drawdowns of more than 50%. For volatility-averse investors, this could be unappealing, but on the other hand, it's pretty amazing to see your buying and selling seasons penciled into the calendar so clearly. The report then turns to the drivers of Bitcoin's price action. The authors point out that BTC has no traditional counterparty risk, depends on no centralized system, and is not driven by any one country's fortunes. This means it has little fundamental exposure to other macro risk factors like banking system crises, sovereign debt crises, currency debasement, geopolitical disruption, and other country-specific political and economic risks. However, it's not that BTC is unaffected by these macro risk factors, it's just not so much to the downside. Because, as the report explains, these very risk factors are actually drivers for Bitcoin's adoption. Specifically, concerns over global monetary instability, geopolitical disharmony, US fiscal sustainability, and political stability are exactly what makes BTC so appealing. As an example, the report highlights the build-up of national debt in the US and elsewhere as a particularly powerful driver. If you're not caught up on the mounting national debt crises around the world, you can get up to speed with our video on it over here. But, as BlackRock points out, spiraling national debt is increasing the appeal of, quote, alternative reserve assets as a potential hedge against possible future events affecting the US dollar. The authors cite their own experience with clients and claim that this driver, quote, explains a substantial portion of the recent broadening institutional interest in Bitcoin. So, perhaps you can see how TradFi investors' perception of BTC has evolved from wildcard to flight to safety in times of macroeconomic stress. Or at least this is the case for investors who have a solid understanding of Bitcoin. I say this because the market tends to show a mixed reaction when faced with macroeconomic shocks. As the report explains, BTC usually dumps pretty hard before quickly recovering and proceeding to rally. This price action suggests a market divided between those who consider it a risk-on asset and those who view it as a flight to safety. The authors attribute this dump and pump reaction to 2 factors, one being the immature nature of the crypto market and investors' understanding of Bitcoin. This makes sense, but we find the other factor more persuasive. And that's the fact that Bitcoin trades 24/7 and settles to cash almost instantly. Because it is so saleable, it functions as a kind of alarm bell during periods of stressed liquidity in traditional markets, especially over weekends. Although, for what it's worth, there's also a third factor that we can't leave out, and that is just leverage traders getting liquidated. Leverage degens are a huge part of why BTC tends to dip so hard whenever financial markets get spooked. One liquidation tends to trigger another, and this domino effect drags the price of BTC down more sharply than most people expect. But, unlike traditional risk-on assets, BTC tends to recover very quickly and continue outperforming everything else after macroeconomic shocks. To demonstrate this, the report compares the 10-day and 60-day returns of the S&P 500, gold, and BTC during major geopolitical events in the last 5 years. Of these events, the pandemic is the clearest example of BTC dumping in the short term before rallying hard. Here, the authors take the 11th of March 2020 as their reference point, a day when the Dow Jones Industrial Average fell by 10% amid pandemic fears. 10 days later, the S&P 500 was down by 20%, gold by 9%, and BTC by 25%. In this case, BTC suffered the worst sell-off, but the 60-day returns show a reversal of fortunes. The S&P and gold just about recovered from their losses, printing gains of 2% and 3% respectively. Meanwhile, BTC was up 21%. However, when you take these macro events in aggregate, BTC outperforms over both the 10-day and 60-day periods. This is not surprising because after a shock, BTC rarely takes 10 days to recover. It's usually much faster. If we wanted to really show BTC's dump then pump reaction to macro shocks, we should probably look at the 3-day rather than the 10-day returns. Case in point, the flash crash on the 5th of August. As a reminder, this was related to the Bank of Japan raising its interest rates and the consequent unwinding of the Japanese yen carry trade. If you're not sure what that was all about, well, you can check out our video about it here. Anyway, on that day, markets around the world dumped hard. BTC dropped 7% in 24 hours and the S&P dropped 3%. Mind you, this event coincided with crypto-specific bearish catalysts, including Mt. Gox distributions and Genesis liquidating large amounts of crypto for creditor repayments around the same time. Yet, despite the confluence of bearish happenings in the crypto market, BTC recovered and overtook its pre-dump level within 3 days. By contrast, the S&P 500 took a week to do the same. So, at least in this case, BTC dropped twice as sharply, but still bounced back twice as hard as the S&P. Now, let's go back to those 10-day and 60-day returns for a minute. At the time of making this video, 60 days haven't yet passed since the 5th of August flash crash, so we'll leave this one out. That leaves us with 5 major macro shocks from 2020 to 2023. On 3 of these occasions, BTC printed 10-day returns in excess of 10%. By contrast, gold was up 10% on just one occasion. Meanwhile, the S&P never saw a 10-day return of more than 7%. It's a similar story for 60-day returns. BTC was up between 15 and 131% on all 5 occasions. The S&P managed to print 12% one time, but less than 5% on the other 4 occasions. Similarly, gold returned 11% once, but sub-10% returns on every other occasion. So, based on this data at least, BTC bounces harder and runs faster than gold and the S&P 500. What's not to like? It dumps when everything else does, but over timeframes even as short as 10 days, this co-movement evaporates. It doesn't amount to any statistically significant correlation in the long term. Bitcoin just tends to do its own thing and doesn't take its marching orders from gold, the S&P, or any other major asset class. As the report's authors put it, BTC has, quote, risk and return drivers that are distinct from traditional asset classes and that are fundamentally uncorrelated on any long-term basis. This is made clear on a graph showing the trailing 6-month correlation of BTC and gold with the S&P 500 over the last 9 years. And what a mess it is. It looks like a careless application of mustard and ketchup on a hot dog. The average correlation is 0.1 for gold and 0.2 for BTC. And this is ultimately BlackRock's pitch to its investors in this report. BTC's value to TradFi investors is its weak correlation with other major asset classes. If you're wondering why this matters, the clue is in the report's title, Bitcoin, a Unique Diversifier. Alright, let's rewind for a moment. In the introduction, the authors explain that one of the most common questions BlackRock's crypto-curious clients ask is Bitcoin a risk-on or risk-off asset? Now, the concept of risk-off may be unfamiliar to you degens out there, but the risk-on, risk-off binary is a foundational principle for structuring portfolios in TradFi. You've probably heard of the traditional 60-40 portfolio where 60% consists of risk-on assets, typically stocks, and 40% is risk-off, typically bonds. Heck, plenty of us in crypto use this structure for our portfolios too. It's just that, barring stablecoins, the most risk-off asset we have is BTC. So, a conservative crypto portfolio could be 60% BTC and 40% ETH. Funny how risk is subjective like that. Oh, and by the way, if you want to know exactly how we at the Coin Bureau are structuring our portfolios, we share all of our crypto holdings with members of the Coin Bureau Club. Aside from getting the scoop on what we're buying and selling, our members also vote on promising low-cap cryptos and protocols for us to review each week in the classic format that we made our name with. But that's not all. The team and I share regular market updates, insights, and alpha in the private Coin Bureau Club Discord channel, where you'll find the most welcoming community in all of crypto, shill-free and packed with the high-quality information that can help you get an edge in the market. We'd love to see you there, so if you're interested, you can find out using the link in the description. Anyway, back to BlackRock. Now, the fact that their clients are asking in earnest about Bitcoin's risk profile is pretty remarkable. Just a few years ago, BTC was dismissed as a gamble rather than an investment, and not something to be taken seriously by TradFi types. And now they want to know if it's a risk-off asset? Well, well, well. Now, we'd like to say this is a sign of how far crypto has come, but to be honest, it's more a symptom of bifurcation. In other words, there's Bitcoin, and then there's everything else in crypto. The gap feels pretty wide at the moment. Will it get wider? Well, that's a question for another video, but let us know in the comments what you think. Anyway, in response to this risk-on, risk-off question, BlackRock explains that the answer is actually neither. The authors acknowledge that BTC is a relatively risky investment by itself, but this is when you compare it to, say, bonds or whatever Warren Buffett is buying. However, Bitcoin's unique properties make this a square peg in a round hole situation. BTC just doesn't fit into the same traditional risk profiles as stocks, bonds, other commodities, real estate, and so on. This is because, as we've seen, its risk and return drivers are, quote, starkly different and, in many cases, inverted versus most traditional investment assets. Now, rising geopolitical tensions, spiraling government debt and deficits, relentless currency debasement, and political instability. All of the things that are considered risk factors for most traditional investment assets, and generally very bad for us and the world. Well, it looks like they're pretty good for BTC. Just look at the table we saw earlier. In some of the hairiest situations the world has seen this decade, BTC has outperformed other major assets. To recap, the US assassinates Iran's top military commander. BTC rallies. The world is terrified by a global pandemic. BTC dips and then rallies. There's turmoil over the US presidential election. BTC goes absolutely nuts. Russia invades Ukraine. BTC hiccups and then rallies. There's a regional banking crisis in the US that affects banks serving the crypto industry in particular. BTC, let's see here, yeah, it rallies. Now, BTC may be a young asset compared to anything else that TradFi investors are interested in, but it has clearly passed many macroeconomic stress tests with flying colours. However, it's worth pointing out that there is a final boss that Bitcoin has yet to meet, and that is a recession. So, the last recession happened in 2008, and real crypto heads will know that the disastrous banking practices that caused it were Satoshi's inspiration for creating Bitcoin in the first place. The Genesis block was mined in January 2009. So, it's kind of funny because for an asset so closely associated with cycles, BTC has never been cycle-tested in the macroeconomic sense. The global economy is guaranteed to fall into another recession at some point, and some people are worried that one is overdue. So, this begs the question of how BTC will respond. Well, that might depend on the catalyst. For example, if spiraling government debt gets out of hand and there's some kind of currency crisis, maybe with, say, the Japanese yen, BTC will likely be in high demand. Then again, fiat currency crisis disaster is basically the Bitcoin maxi's dream come true, so this might be wishful thinking. If the next recession is caused by something less obviously bullish for BTC, well, then it's harder to say. BlackRock's report shows us that BTC can't be pigeonholed as a typical risk-on or off asset. It tends to outperform in times of geopolitical tension and macroeconomic stress, but it is also the most liquidity-sensitive asset there is. If liquidity dries up for an extended period, it's probably too much to ask for BTC to go on some crazy tear. But, on the other hand, in a recession, liquidity will probably never dry up for an extended period. That's because, no matter what catalyst kicks off the next recession, central banks are likely to respond with more quantitative easing. More QE means more fiat currency debasement, in which case Bitcoin literally can't lose. This is just our best guess though, so let us know what you think in the comments. How do you see BTC behaving in a real recession? What does max pain even look like? As far as we, and BlackRock, can tell, most of the bad stuff that can happen in geopolitics and the global economy only seems to make Bitcoin stronger. I'm not sure if we should be happy about that, but well, I think I need to own more BTC. Alright folks, we'll leave it there. So, if you got something out of this video, don't forget to smash the like button. And if you're not subscribed or you haven't yet turned on your bell notifications, go on, be kind to yourself. As always, thank you for watching, and I will see you next time. This is Guy, signing off.